Just a real quick introduction from me. One, I wanted to make sure that you know everyone who's here from NYC Life, just representing the exchange. We have Christina, we have Netta, we have Nancy from our Chicago team, Peter Best, Paul McGregor, Mark Phelps. They're in from London. Well, with one exception. Mark came in from London yesterday. He's staying. He's staying for a while. So we're continuing to expand the resources in Chicago, building our presence here. And, you know, the business definitely warrants that. We're very grateful and we're very appreciative of all the business we're seeing from you guys. We certainly hope that this presentation will be the catalyst for some of you who haven't looked at the European markets to start looking at these products as well. Today, the real star of the show is going to be not David, but Dan McGrory, who's in from London. He's going to give you his background and his information. You'll see, interesting experience from Chicago into London, coming back now and having looked at a lot of different global markets and products. He has a lot of great ideas and great thoughts to share with you today. We're going to cover markets like the short-term interest rates in Europe. We have the Euro Swiss, we have the Euribor, we have the short sterling. There's a range of products within the EMU and Eurozone as well as outside. And these days, there are certainly very interesting opportunities associated with combining those products and transacting them one against the other. We're going to talk about gilts, short, medium, long gilt, all futures products that are available on NYC Life, and some of the applications of these products and these markets against our own portfolio of products, as well as certain other products that trade on other exchanges. We understand that the great opportunity today is to have the choice of products across exchanges and venues. We think that our markets fit very, very well with many others and provide tremendous trading opportunities. Some of you already trade our markets. There are many market makers, many liquidity providers, and many users in Chicago that we have strong relationships with. It's always nice to see you. For those of you that don't know us and when we don't know you, we'd love to discuss all these in greater detail after the presentation. So thank you again for coming. I'm going to hand it over to Dan now.
Hello, my name is Dan. Originally from Chicago. I moved to London in 1996. I was trading options on the floor there. And it was going pretty well. And then everything kind of changed and everything moved upstairs. So I had to kind of learn how to trade again, essentially starting with one lots and worked my way up. And I'm at a group called Schneider now. We've got about 240 traders. And we trade all this stuff, all this life stuff. And what we learned over the last 10 years is that we're not very smart. But what we are is diligent and paying attention to everything. So a lot of these trades might seem simple and basic because we acknowledge we're not going to outsmart what's going on. We're just going to try and be a little bit quicker and a little bit more diligent about what we're doing. We're sitting there for 10 hours trying to take ticks out of the market. So hopefully this isn't too basic for you guys. If you think it is, just try and raise it up a notch by asking a smart question. If you've got an immediate question, ask right away. Otherwise, kind of wait till the end, and we'll go from there. Euro Swiss. We're going to start with probably the least interesting of these things that we look at. I'm looking at essentially flies against flies. So this is the deck 10 fly against the March 11 fly. And we like these types of things. They hold in, it's a couple of ticks wide for weeks at a time, sixes, down to O's, down to neg ones. And all I'm looking for here is an opportunity to put on sixes or fives, take them off for, say, ones, zeros, then put on maybe neg ones, neg twos, take them off for ones, zeros again. This is the next box over. This is 1 by 2, actually. So this is deck 10 against, it's going to be the deck 10, deck 11 calendar. Sorry, deck 10, deck 11 calendar against the March SEP calendar. And here's how I'm going to trade it. This is I'm going to work here, March, June, 16, 17 against the deck SEP. So that's the first chart we looked at. So if we flip back. So here, if I want to do something like 4s, 5s, or O's, I'm doing 3 times this, so 16 times 3, minus, say, 52s or 53s, which gives me, I had to write all these numbers down, sorry. So So I'm doing 51s against 53s. I'm doing 17s against 52s. Gives me ones in the spread. So if I flip back, yeah, ones is the price I'm willing to buy, more or less. So I'm going to generate orders like that. So I'm willing to sell 17s to buy, say, 52s. Now, like I said, we're starting with the slowest market first, the Swiss. It doesn't look like there's a lot going on here. This isn't the first half hour of trade. So I've generated an order, essentially. I can be 17 offered as long as I reckon I can buy some 52s. If I go back to here, this is the one by the deck against, sorry, March against, deck against the March SEP. So here I'm looking to say sell something like 4s or 3s and buy O's or neg 1s again. So if I do, if I'm doing 33s, I'm buying these to sell something over here. If I buy 33s and sell 69s, I'm doing positive 3s in the spread. Whoops. Which is something I'm willing to do against my chart. Does that make sense? Pardon me?
Did you say you're trading 2 calendars in this one order?
Yeah, that's all I'm doing. I'm trying to generate a lot of orders using my charts. So the more orders I can generate, the more stuff I can work and hopefully get I'm picking up a tick, I'm picking up some edge. If I could fill down a bid, fill down an offer, I'm hopefully picking up some edge each time as long as I've got another thing to lean on. So I'm working these. So I'm doing 3 times as many of these. I need to get these. So I'm working these to lean on this market. Over here, I'm working these to lean on this market. So I'm doing 2 times as many of these to get these.
What were the candles?
This is March 11, June 11 against Deck 10, SEP 11. This is in Euro Swiss. This is March 11, SEP 11 against Deck 10, Deck 11. 3 of these versus 1 of these, 2 of these versus 1 of these. It just gives you these really nice charts. These are the kind of charts that, this isn't being smart, this is working hard. I love stuff that looks like this. I've got, significant confidence that if I'm selling 3s, I'll get something out of it. If I'm buying neg 1s, I can get something out of it. If I look at a FTSE chart or an S&P chart, I don't have confidence to buy and sell. I'm trying to find a way to generate a trade for myself. This is further back the Swiss curve. And similar setup here. I'm trading 3 times June SEP against March DAC, 2 times June DAC against March 11, March 12. Like I said, the Swissy is not the most interesting. Sterling a bit more interesting. Once again, this is the kind of chart I can trade. This is the type of stuff that interests me. This is going to be the deck, what we would call the deck double fly. So it's March, June against deck SEP. And my ratios are all the same again. I'm doing 3 of these against 1 of those. So here, if I go flip back, this one, I'm going to be trying to sell something like O's or neg 1s. I'm going to be a buyer down here, neg 5s, neg 6s. So if I can do 34 times 3, I get 103, 102 versus double O's. So if I'm buying these and selling these, I'm trading 2 in the double fly. Sorry, neg 2 in the double fly, which is something that I'm willing to do. Now, the fact this is bid on 25,000 tells me I want to do this anyway, and then my chart just confirms I'm buying these and selling these. I'm actually getting short that double fly at a reasonable price chart-wise. I've got confidence that I'll be able to take it off for neg 4, neg 5. And in this one, which is the 1x2, I'm doing March SEP against DAC. So here, neg 3.5, neg 3.5s, neg 4s, I'm a seller. Neg 6, neg 6.5, I'm a buyer. So I just trying to generate some other orders now to do this. So 70 times 2, 140 minus 34, those are 6s. Yeah, -6 will be a buyer. So what I want to do here, sell 70s, buy these 34s. Just looking at what's available here tells you that that's probably a good thing to do anyway. This is better offer than this. This is better bid than this. So the charts are kind of confirming what you would get intuitively by looking at it. Another thing I'm trying to do here is generate lots of orders so that this game for me becomes order management. As long as I can manage more and more orders and they all suit what I'm trying to do, I can work stuff up and down the whole curve. This is further back in the sterling. They tend to look like they hold in tighter, but they trade less often. You're going to use the same setup here. I hope this isn't tedious or boring, but what I do is a bit tedious and boring, but it pays. It's the same ideas over and over, and it just comes down to how much you want to work them. So here, -2s to -7s is kind of what I'm looking for. So -2s here, 33 times 3, 99s, 95. So there's -4s kind of available here. But -4s, I'm not really interested in -4s. I want to be selling something higher, buying something lower. So I haven't really generated an order there, but I can generate an order down here. I can be 32 bid to sell something like 95s or 94s. I could be 34 offered to do it on, because 34s against 95s gives me -3s, whoops, which is that one, which yes, we would do that. So I can be 34 offered, I can be 32 bid, and I can do the corollary orders over here, which would be something in the region of 92s versus 98s. I tend not to do that. I want to do it this leg first, because I'm doing 3 times as many. This leg, just by the nature of it being wider, is whippier. Similar idea down here. Once again, the sterling stuff doesn't, in the back months, it's a bit slower. So these are the kind of trades we'll put on, hold them for 3, 4, 5 days, maybe a week. We get this box in and try and take 2, 3, 4 ticks out of it. As looking at just an individual 1x3, this isn't a business. But all of them across the curve can be a business. You get to generate lots of orders. Another thing we look at is we trade the sterling against this 2-year gilt, which is a relatively new thing now. It's slowly getting better for us. In the beginning we had it go and it wasn't so great. It is getting better. This looks a bit more volatile, it is, but it gives you a lot more opportunities to take 1 and 2 ticks throughout a day. And this is, I'm trading 8 sterling against 5 2-year gilts. And I can talk about that later, how we get the duration weighted prices there. This is the DEC sterling, and this is the March 11th sterling against the 2-year gilt. Those are the two I'd look at to trade. And I just set it up something like this. This is your 2-year gilt, and then you get to trade your outright sterlings here. And I'm pricing it 4 times 1. So I'm doing 6 times 4 minus, say, 20s. 21s is mid-market. So that's trading, I should be able to sell these things 24s minus 21s at a price of 3, which is this chart here. So yeah, which is actually 23s if you do the whole math. I'm dropping out the handles because it doesn't move that much. And same thing with the March. I'm going to buy or sell 5s or 4s, to buy or sell my shats 8x5. I'm looking for really 1 to 2 ticks out of it. So if I buy 54s and sell 19s, I want to sell 55s to buy back 19s or 20s. 20s gives me a scratch. I'm looking for 50 pounds. It's 50 pounds a tick, essentially, for every 8x5 I do. This is the front end of the Euribor curve. This is where we spend a lot of our time. This is the front fly. The guys who are doing this business, this is the front fly, this is the second fly. We find the front and the second move a bit more, and they're a bit more directional. There's a lot less give in them. The guys who trade these tend to trade something like this. They're looking at the fly book as a kind of guide, a map, as it were, to tell them what they should be doing here in the various calendars, and then into the various legs. The guys who tend to trade this stuff tend to be aggressive, and they're in and out all day long, tend to be flat at the end of the day. Whereas the other fly, the further back flies, we tend to hold them for longer periods of time, And we tend not to leg them as outright. We tend to leg them in here in the calendars. We really only use this fly book to get out of stuff. We don't enter this way. If I'm working an offer here and I get them, it's probably because it's already trading half tick through me on legs, if you've had a bit of skill. So here, the type of thing we're looking at here is this is 19, 19 and a half. Yeah, I want to be 19 and a half offers. I'm definitely going to work some 9s here, because 9s and 9 and a halfs will do me, which gives me, 1.5s in the fly, as long as I get that leg done somewhere. And all I'm doing is using these to kind of guide me through these, where to work bids and offers. And again, it just becomes a kind of function of how many can you work? How many of these can you keep track of? I can work 19, I don't really want these 19s, I want 19 and a halfs. I want 21 and a halfs, and I want 19 and a halfs. I don't have to look at the chart, I can tell you that that's a good price. If I get something like that, I'm probably getting something along the lines of 1.5s here and 1.5s here, or some combination of those given the various legs. This is an aggressive kind of in and out trade. This is the same thing we looked at before in the sterling and the Swiss. This is the March 11 double box. Again, this is the type of stuff we really like. Nice tight range, lots of confidence that I can buy, that when I get some O's, I'm going to make a tick or two. When I get some 2s, or better yet, some 2.5s or 3s, I'm going to make a tick or two. And this is the next, pardon?
What's the noise on the previous chart at the right side?
Oh, this is a bad open close print.
It's just bad.
Yeah. You can see it's just an open close situation. You wouldn't get that at this part of the curve, not in reality. This is the 1x2 in the same stuff. A thing to be aware of is in these 1x2s, I quite like these because you're trading March, which is real business. June SEP will be real business. Banks, people want to do this stuff. March DEC, this is all going to be locals, in my experience. Locals doing this type of thing. June DEC, this is going to be locals doing this type of thing. March, this is going to be real paper. People will come in here and do 500, another 500, another 500, and give away the tick to do it, which lets me play in this a bit more. This will tend to be real paper and locals here, but I find that these two, the 6-month and the 9-month, tend to be locals trying to manipulate these against each other. The same thing that I'm trying to do. So this is a less reliable thing to lean on than this or this. Here I'm trying to let's get a price off it. Want to sell some 2s, buy some O's. So 22s times 3, 66 versus 66. Those are the O's. So I can sell 6s to buy 2s. No, I don't want to do that. I want to do the other way around. I want to buy O's. So I want to sell 22s to buy these 6s. So I'm generating an order there. So I can also buy 4.5s to sell 21.5s. So do you see how we think about it? We say, here's a price we want to do. What orders can we generate on the back of it? And then we just start queuing them up. I'm less likely to go this leg to this leg. I'm much more likely to go this leg to this leg, or this leg to this leg. This is further back, the Euribor curve. Again, like the sterling, they hold in nicely, but you tend to be able to do less of them, and you have to hold them a bit longer. And you can see that the volumes are a bit less as well. Just you've got 8 by 11,000, 1,100 by 2,600, and then if you do the equivalent, maybe a year further down the curve. Now this might be appealing. This is appealing to me in the sense that I don't have to put in huge amounts to get filled on the way the algorithm works. I'm a small trader. A lot of my guys are small traders. We tend to have to drift to where we can get business done. So I'm more likely to get stuff here than in this market, and obviously, not very likely here compared to something like this. So that's appealing to me in a way, and it might be to you if you're not used to doing this. Yep.
What kind of allocation algo are you dealing with? Is it FIFO or?
It's not FIFO. It's I don't know the exact details. That's a question for Mark.
A very brief rundown. We use priority time pro rata algorithm. So the priority element, you can have up to 500 contracts in the Euribor. and you get that by improving the market price in at least 50 contracts, so up to 500. Once the priority has been removed, so the market trades that 500 out, it's then on a equal weighting between your queue position and your volume. So a very basic example, if you like, the time element is worked out by, if there were 4 orders in the queue, you would add up the positions. So 1 plus 2 plus 3 plus 4 would give you a total of 10. And the first of 4 orders would be given a score of 4 out of 10, 3 out of 10, 2 out of 10, the last order having a time score of 1 out of 10. You'd then multiply those numbers against the volume factor, and if you had those 4 orders all with 100 lots, they'd all have 1 over 4, 1 over 4, 1 over 4, 1 over 4. So you combine those 2 numbers together, normalize them, and that's how you get your allocation.
Simple, really.
Well, if we really want to get scared, at the end of the booklet that we distributed, there is a formula there. So we certainly make it very transparent. It's in the appendix. So you can sort of work through it all the way towards the end.
I mean, in short, I think, like you say, that's complicated and not something you're going to be able to use on your day-to-day trading, but you should be aware there are volume and queuing components in the algorithm.
I find that we get better fills in this stuff than we're getting in Eurodollars, for instance. The algorithm leans up, pardon me?
Are you trading size or?
Well, I don't want to have to trade more size than I want. I don't want to have to be putting in 2,000 lots to get a 200 lots.
You're just queuing up your orders in the morning when you get in, or?
To an extent we do. Not, like I said, not so much. We will in the 3-month stuff. But anything outside of that, we're not really going to queue up too much. We're much more going to be hitting and lifting because we're getting filled in the 3-month. What I'm getting at is that this is more attractive to me because I don't have to put in 2,000 to get 200. I can put in 400 and I've got a reasonable chance of getting more than, getting 200 because of the time size allocation. What I find with the Eurodollar is that I'm getting them all when I don't want them, and my next leg is gone. And this doesn't happen as much here. And I have looked at both for years, and especially electronically, because I don't care what I'm trading. I trade what makes me the most money, given the amount of time I have to put in. So I find this an easier trade, and especially for people starting out or new guys, we will always stick them in something like this, rather than something where it's bid for 15,000. Now it's offered. Now the next price is offered in an instant, and really nothing's happened. That's just confusing for them. Another thing we do a lot of is European TED spreading. So this is the Euribor against the Schatz. And we find this much more attractive a day trade than the US equivalent because the Schatz trades a lot. And we get to flip it around a lot of the time. The chart doesn't look so great, but these aren't 4s to 5s to 6s to 7s to 8s to 9s. It's not that big an increment. It's not, inside a day, we've got 7s to 11.5s, 12s. So it's had a 5-tick range, which isn't so bad. And it does tend to retrace quickly enough and often enough that you get to take a tick a lot of the time. This thing we do now, Schatz is a straightforward FIFO market, so that suits us as locals. At least it does me. It really suits me as a local because it pays me to be quick and pay attention. So if I'm quick, I'm at the front of a lot of queues. I'm getting good fills, that type of thing. The Euribor side, what I'll tend to do is work my Euribor leg because it's a bit harder to get and lean into the Schatz. So here, and we trade this 4x5. That's all down to duration weighting and tick normalization. So each big tick is 50 euros, a half tick's 25 euros. And I chart it up 2x1. So this is 8.5 times 2, 7s minus 7. So this is trading O's. I flip back here. Sorry, 10s. It is about 10s. Actually, no, wait, 8.5, 7. Yeah, 10s. 17 minus 7, 10, sorry. And I'll definitely tend to look at more than 1 month against the Schatz. So, have I charted that one up? I don't think I have. So the deck TED is the third month in. There's decent size here. Guys will tend to play a bit more here. There's probably not 7,800 here. There's probably about 4,000 here. Guys do play that game a bit in Euribor of putting in 1,000 because they need 400, that type of thing. Not so much though. I do like the Schatz because it's not a life product, but it does trade a lot. And the FIFO system we really like. This is a further back TED. Notice it moved. This is last Monday. Essentially, my guys were short this thing every day. That's the whole week. And we still pretty much scratched because there was enough noise, there was enough pullback over and over and over that we were able to take them back off, put them back on, take them back off, take a tick, lose a tick, scratch a few, take a tick, lose a tick. And it went on like that. It was like a war of attrition for a week. So be aware that that can happen. And then we got a bit of relief, and then it was all right. We made some money. The further back TEDs tend to have they're a bit more direction to them. So if you see the bubble Schatz rallying and pushing, you want to be long this thing, generally. That's the next TED over, the SEP 11 TED. I'll generally look at 2 of them at a time, some kind of arrangement like this. So I've got the June, the SEP, and then the June SEP calendar, which I'll pay attention to as well. If the TED's looking cheap, I want to buy Euribor and sell Schatz, I will look at the calendar and see, is one of these legs better than the other? So if the calendar's going bid, or has been going bid, for instance, and the TED looks cheap, I'm going to buy the June TED, not the SEP TED, to at least try and be on the right side of the calendar. And and all the permutations of that. If the TED spread's expensive and the calendar's going offered, I'm going to try and sell the June one rather than the SEP one to try and get the right side of the calendar. And there's 2 more versions of that. And what'll happen, maybe 1 out of 5 times, I'll be long the June one, short the SEP one, which makes my Schatz 0, and then tends to give me a synthetic, long from 21.5 or short from 22 in that calendar. So then I just get the pop-in order and then try and work against the Schatz again. I've taken it back off, or I end up with one of these, and it takes me back to my 1x3 fly against the fly thing, which lets me then work a wider out order in the 9-month to put the 1x3 on at a reasonable price as well. So what we try to do is integrate all these things to work a lot of orders and try and get paid for our time and effort rather than for trying to be too clever. That's just the June SEP calendar. It's not a lot going on there. The last one we'll look at here is the 5-year, is the bobble, European 5-year. And this one moves as well. It's a bit more fun to trade. You really don't want to be holding these overnight. We trade this 8x5, 8 Euribor to 5 bobble, and we chart it up 4x1. So here, I'm trying to buy or sell my Euribor to buy or sell bobble. This is 50 euros a tick per increment here as well. So 4 times 4 is 16s, 5s. My 90, essentially this is 91 print there. The charts aren't in perfect synchronicity with the screenshots. And I would set this up. This one I would trade against further back the curve. So SEP 11 against Deck 11. I would definitely have the SEP 11, Deck 11 calendar up as well to lean on, giving me an indication which way to go when the TED gets cheaper expensive. And that's about it. I've got 30 guys doing this, and there's about 200 in total. It's as simple as that. This is all we do all day long. No real secrets.
size that you put on?
In which?
Well, for instance, when you're just doing straight Euribor spread versus spread, or the shats against the Euribor.
We get to thousands. I think if you've got more than 2.5, 3,000 on, you might want to consider, we will average these things as well. If I'm selling 4s because they're looking good, and I'm offside and 5s come on, I'll do some more. We have, in fact, almost all these trades, we will average them. I know that's against all the rules, but it's been working for us. I'm sure people have much bigger size than that on.
You tend to hold it for a few days, you said?
In the back we do. In the front we tend to be in and out, and we like to be flat at the front. The front will tend to move and not come back at all. It can be very aggressive. Well, not aggressive so much, but painful. It'll go a tick, then another tick, then a tick and a half, then another tick, then another tick and a half. So you're almost not noticing. You're going, aren't these great? I sold 7s were a great sell. Now I'm selling 11s. Fantastic. Well, in 2 weeks' time, it's 19 bid and ain't coming back. So those things, the ones at the front, we try to be flat. Try to get in and out quickly. It's much more of an aggressive jobbing trade. Further to the back, stuff in the reds and the greens, you have to hold them. Because the business doesn't turn up every day necessarily. I've got guys who will hold stuff for a month. It's not their main business though. They have a main business, bread and butter kind of TED trading, for instance, where they're in and out all day long, trying to be flat, making ticks, and they'll hold this other thing and just wait for it to, they'll get it on at a good price. They might see it a tick offside. They might see it scratching for 3 or 4 nights in a row. They might see it a tick onside, but they can't quite take it off. We're patient with those. Like I said, any one of them is not going to make you a lot of money, but if you can work them all. Another thing we like to do is we will trade them against each other. So if I got the sterling count, if I got the sterling fly on, I'm long, say the third fly. I will look to sell out the Euribor third fly or the Eurodollar third fly. We do like to roll them around.
Do you see a high correlation between the sterling and the Euribor?
It does work. It works in the way we're doing it, where we're working lots of orders. I'm not putting it on to hold for 6 months and try and make $1 million out of it. I'm putting it on because I reckon I can take a tick in this one, a tick in that one, a tick in that one, a tick in that one. I might give a tick away there, but then I get to be flat again, do it again. I think right now, given that no one but the Swiss are going to be moving interest rates for a while, it's legitimate to look at those as a hedge against each other.
It's hard to see some of your pages exactly what it was that you had up, but are you doing a lot of flies versus flies or spreads versus spreads?
Flies versus flies is the chart, but the way we put them on is spreads versus spreads. We rarely use the fly book. Like I said, if I'm getting filled in the fly book, that's because everybody in the world has done it a tick better. I'm only using the fly book to get out because I've got to go to the bathroom or something like that. I can go back. Do you want to look at anything?
No,
I'll just kind of show you the setup. I'll go back. It's easy. It's a fly against a fly on the chart,
right.
but I'm entering and exiting it as a pair of spreads versus, and then the other pair of spreads. I think it's easy to understand that way. It's certainly easy to show somebody how to do that. I deal with a lot of guys who have no idea what they're doing, and they can kind of understand that after a couple weeks.
So you're working a bid, okay, to enter in, you're working say the bid side, you're comfortable on the upper left side, you're saying, okay, the bids all the way down are pretty decent, I'm gonna go in there at
Yeah, well,
that price.
I'm only working this bid
Okay.
if I reckon I can sell some of these,
Okay.
or if I'm willing to sell that bid.
Right, okay.
That's all I'm doing.
And that's the leg right there.
Yeah, and as soon as these are going, I'm pulling these, and I'm trying to do that all the way down the curve, essentially.
Okay. And once you do that upper, then you look to neutralize yourself or get the other position on the lower part. Is that what that is all?
This is 1 by 3. This is a fly against a fly,
Okay.
and this is one of these fly against flies versus the next one over.
Okay.
But once you do the algebra, you reduce it to 1 by 2, skip a month, 2 by 1.
Okay.
And like I said, the nice thing about that is you get to trade the 1-year calendar, which does have some interesting, legit business. Mm-hmm. It's not just people like us. Sorry. but people will come in and give away edge here to get stuff done. Yep.
Can you talk about your weighting? Like I think you said your Ivor Bible, you were trading 8x5 and you were charting it 4x1. So
Yeah, well, the charting was more a function of how easy can I do it in my head, because it's moving around. So I can say that's 7s, that's 9s, that's 11s. I want to sell 11s. So I'm trying to adjust the chart. The original, if I look at the original TED spread that we did, which is the Bohr against the Schatz, the Bohr had a half tick, and the Schatz didn't. The Schatz had a full tick. So to make life easy for us, we multiplied the Euribor times 2 to essentially eliminate the half tick. So you could take a quick glance at the screen and go, that's 24s, that's 25s, that's 23s, that's 24s, just quickly. And then they stuck a half tick in the Schatz. So kind of went against what we were trying to do, but so now we go 23s, 23 and a halves. So we took that same convention and applied it to the bobble. But you need to do twice as many Bohr to kind of make to normalize the tick size. So in the original TED, if I buy 23s and sell 24s, I've made 50 euros. And in the bubble TED, if I buy 23s and sell 24s, I've made 50 euros. I'm just trying to normalize it and make it easy to take a quick glance and say, well, 17s against 7s is 7s. 18s against 7s is 8s. So that I can quickly do it and work the orders out. And there's no kind of science behind it. But that's just the charting. It makes the charts look like the reality of the interest rates against each other. Yep.
For U.S. market, what time is the busiest time you think for your Ibors now? Just curious.
Over U.S. figures, frankly.
It is? Okay.
Yeah, we do a lot of business then.
I used to trade them a lot, like 3-4 years ago, early in the morning.
Well, we do have good mornings. The opens are nice because they still have an opening auction, so we get a bit of edge out of that. And then European numbers, the German ZEW is 10 o'clock UK time. That tends to be good. What's the other one? IFO. The Euribor doesn't react too much to the UK figures, so you can pretty much leave that out. And then, by 11 o'clock we should be done in theory, but now we just sit around and wait for the US figures.
Actually, most of the business is done in the UK afternoon. Tends to be the majority of volume is done in the UK afternoon. I mean, the big days when we have, although the ECB, they never change rates anymore, it's when, the head of the ECB talks. He does his presentation afterwards.
Which is 1:30
Yeah.
our time. So, that's always fun.
But we do get a lot of business on the open. I mean, the first hour or two of trading is
used to get up there.
I'll tell you one thing we measured last year: 60% of Euribor futures volume is after 6 a.m. Chicago.
Well,
Just looking at over a 6-month period.
now that they have the auction in the morning, it might be worthwhile to look at it again if you can get up, 2 a.m., whatever time that is. We have a lot of guys who are done by 7:05, 7:10.
In the first TED that you mentioned,
Yeah,
you said that you're using the Schatz against the third one, your Ivor?
yeah.
Okay.
I'm picking a month as a proxy for the front 8.
Right.
Technically, that should be using all 8 against the Schatz since you get 2 years worth of curve.
Right.
I can't trade all 8. I can only trade 1, maybe 2 at most. So I pick a proxy. The proxies that tend to work best are the 3rd, 4th, 5th, and 6th month.
Sure.
But just be aware the 5th and 6th have a bit more whip to them.
Do you find yourself leaning on the third and not 4, 5, 6?
I like the 5th month. I like the 5th month personally.
Okay.
It's a bit more fun to trade. It's not 20,000 up at points in time. It's a few thousand up. I get filled. It's cheaper to trade because I get a liquidity provider rebate off from Life.
Okay.
It's cheaper than the whites. Simple as that. So it's like 5 pence cheaper. So, and it's a bit more to it because you can have a view. You can say this is, it is looking bullish today, so I'm going to buy to sell, rather than the other way around. So I was,
All right.
makes it more interesting for me.
Yeah.
Yep.
You mentioned, I'm not familiar with the URI, but the opening auction. Can you just talk about the structure of that a little bit? Like you said, is it sort of open like off a survey or?
No, it just opens.
Okay.
It used to be open. What time do we open? Like
Yeah.
2 in the morning or something?
We used to open, what Dan means there is, we used to open our market from 1 a.m. London time all the way through till 9 p.m. Now we have what's called an Asian session, if you like. That's what I call it anyway. It's like 1 a.m. London time to 6 o'clock in the morning. The market completely shuts then. All the GTC orders remain in the book, but all limit orders then need to be put into the market. And at 7 o'clock we have an uncrossing algorithm that takes place. So there's a new, if you like, print or start to the day's trading. So that's really what Dan's saying there when he means auction.
Okay.
And it's just it's what we would consider kind of like the proper start to trading in for the Euribor market.
So rather than I used to come in the morning and it's already open. It's been open for hours. So all of a sudden I was like, oh, I can't be bothered to come in this early anymore because I'm not missing anything. Yeah. And once they changed that and went back to having an actual open, it became much more interesting for us. We started making money again at 7 o'clock, whereas before we weren't.
Okay.
Because the Schatz, the Bund, and the Bobble all open at 7 as well. So there's enough uncertainty in play and all those things that you can, I'm getting stuff on that's 4 ticks away from anywhere where it's printing in reality. Because I'm selling these and I'm working a bit here and I'm getting them and it's, immediately it whips back into line. I'm taking my money. I'm going to breakfast. In theory.
And I would say what Dan says there is pretty representative of most of the locals in London. Like, I had a trader's wife email me once to say, thanks for the way you open the market now. My husband can come to work at 9 in the morning. But now we've gone back to a proper open. Pretty much everybody is always in for that 7 o'clock open of the market because there's a lot of opportunity there.
Okay.
All right.
Okay, thank you very much, Dan.
Thank you.
I'm just going to wrap up real quickly with a little update on the products. One thing I would like to say about Dan's presentation is, unfortunately, it wasn't in your slide packs.
You don't have to.
And there is a reason for that, and that's because the data was bang up to date. Okay, it's literally, he flew in yesterday and a lot of the data was taken from Monday. So if you do want a copy of that, can you give your email address to Christina Deitel? She's at the back there. Can you put your hand up, please, Christina? Give your email address to Christina before you go, and we can email you the slides if you want to have a look through. Okay. So I'm just going to give you a real quick update on the products, and then we're going to close. As most of you will be aware, we've had a difficult time, exchange-traded landscape. Most of the volumes were down on the back of the financial crisis. And you can see that quite clearly. Here's the major exchanges. I think the good news is we seem to be coming out of that. Hopefully there's not too many more shocks waiting in the system, and volumes seem to be climbing again. I went to see quite a well-known bank that's done very well out of the, seems to have made money consistently out of the crisis. I was talking about how the volumes seem to be returning to exchange-traded derivatives. And they asked me, well, how are you doing against Jan 2008, which was when all the exchanges were seeing absolute records? That's a very good question, I thought. And how we're doing against Jan 2008 is we are actually the only exchange that has improved on that performance. The others have come back and come back quite strongly, but the life markets have actually are peaking back where they were back in Jan 2008. So that's very good to see. And I think that's reflective of a lot of liquidity we're seeing flowing into the Eurozone now, given that there's a lot more uncertainty there. Here's just a little chart picking up, a little table picking up where the actual stir volumes are and the bond volumes across the major exchanges and the options. Something we'd want to note here, our stir options volumes now are averaging over 1 million a day, which is quite a lot higher than a lot of the other exchanges, and that's continued to grow. I know most of you guys will be trading futures, so you're thinking, well, how's that good for me? All our market makers in stir options are delta hedging all day long. So there's a new source of paper coming into the futures market, and that's boosting our futures volumes as well. So I mean, that's something you might want to take into account. It's not just bank flow and hedge fund flow we're seeing into futures now. This is just a little chart to show where the sort of consensus, I mean, the interesting bit here is consensus forecast on what's happening with interest rates in Europe. And the current consensus forecast is going to be a change in rate policy around September this year. I'm not sure about that. I'm reasonably bearish. I still think the central banks are going to hang on to this low rates environment as long as they can. But the interesting thing from your point of view is if you are thinking of trading European STIR products, there's a lot more volatility there now because there's constant speculation about when is this change in policy coming. And that is changing the shape of the yield curve. And going back to what Dan alluded to in his presentation about pushing some of his traders to trade more in the back months, we've seen a real pickup in volumes there in the back months as a result of this speculation about when are those rates actually going to start changing. This is an interesting piece of information. We often get asked, what's the constituents in our marketplace? How many algorithms are there working in your STIR markets? How many automated traders? How many manual proprietary traders are there? How much paper is in the marketplace? Well, this is all estimations, but we've looked at this quite closely, and this is the best data we can come up with. I mean, currently we think there's around 35 algos working in the markets, in STIR futures anyway, daily. Most of them, though, are grey box, what we would call algos that are executing manually with a lot of manual intervention. And there's only a few pure black box. But they do contribute a lot of volume. We think it's around 30% at the moment. And within the top 10 highest daily volume turnover clients, 3 of those are algos, 2 of those are proprietary algos, and 1 is a bank. Okay, and that bank algo is most likely using smart order execution on behalf of clients or trading against other OTC markets. But also within our top 10 highest daily users, 3 are what we would call proprietary traders, non-algorithmic. Okay, so people like Dan's team, they will be using automated tools for sure to get the most efficient execution, but they're not what we would call pure algorithms. And we would sort of refer to those guys more as point and click. So that's the current sort of customer mix we're seeing in STIR futures. Just a quick update on what's been going on in Euribor. As I mentioned before, we've started very strongly. We're trading about 1 million lots a day, and the shape of the yield curve's changed. And the big change we've seen as a result of that is this big rise in green volumes. You know, the green volumes were pretty insignificant 2 years ago, but now they're about 6% of our volume, and the reds have increased as well. And what that means for yourselves, if you do want to trade, take some of those trading opportunities, it is slightly cheaper to trade back there. We do offer more generous rebates. And the details of those rebates are in the back of the packs you've got. They're in. I'm not going to go through them, but they are in the appendices. So there's the current distribution of volume. As you can see, the white volume has come down. Not surprising. So the front of the curve is very, very flat. No one really expects a change in rates policy, but there is this speculation around the reds. When is that rates policy going to change? So overall back month volumes have increased slightly over 2 years, but the big increase we've seen has been where we have market maker programs, which is in the front back greens and the front blues. And those have increased quite dramatically. So there's definitely trading opportunities there. We started a pack and bundle program. I know packs and bundles are very, very popular. Trading in Chicago, lots of trade and that going on in Eurodollar futures. I've been reasonably pleased, and we've had a lot of bank users coming in because obviously they want to take a view on, a whole strip of months as opposed to trading single months, and those are supported by market makers and trading pretty regular volumes now in Euribor, as you can see. Those have increased quite a lot. We offer an immediate rebate in the packs and bundles, so you don't pay full fees. We just immediately rebate you if you start trading those. So there's no thresholds, and therefore it's cheaper than trading, the individual lengths, the individual legs, and say some of the far back packs are free completely. We do have pretty tight prices in there. Just a quick point to note, if you are looking at packs and bundles, the pricing convention on life is different from on the CME. So on the CME, if the 4 legs are up 1, up 1, up 1, then the pack is up 1. On life, it's up 4. Okay, so that's just one thing to take into account. But our market makers are continually tightening those prices. So, for example, I'm probably just a bit lucky here. I managed to snap the red pack when it was a half tick wide. And say in a half tick, 4 months, it should only be 2 ticks wide, theoretically. So we have got market makers pulling the market quite tight for us there. Just quickly on the sterling, I mentioned about trading moving from the whites into the back months. In sterling, it's been really pronounced. So you've seen over 75% come down to about 50% of the volume in the whites now, again offering trading opportunities. And the green increase has been even more dramatic, as you can see there, from where we've had market makers supporting in the back reds and the greens. So it's really driven up our volumes in the back months. And to say that refers back to say, again, what Dan was saying in his presentation about pushing his traders to actually look at more back month opportunities. We do have a pack and bundle program as well in sterling. Okay, so it's not just in Euribor. Very quickly on the short and medium gilt futures. We did launch 2 new gilt futures last year, at the end of last year to coincide with what we call the long gilt roll. Specific reason for that, the UK government is issuing more debt than it ever has in the past. And I know there's a quantitative easing program going on in the US and a sort of, if you like, a very cheap repo facility in Europe. But the quantitative easing program in the UK is out of all proportion to the size of the economy. Forecast to be around 250 billion sterling notional debt by the end of next year. And all that debt is going to have to be released back to the marketplace. A lot of it has been issued around the 4 to 6 year part of the curve. So we had a lot of pressure on us to launch a 5-year gilt to compensate for that. But we felt that there were more trading opportunities to get proprietary traders involved when you look at a short gilt against the sterling. And as Dan mentioned in his presentation, they're already starting to trade a little bit of sterling TEDs, which is really helpful for us. So there is a new trading opportunity. As for the products themselves, they both got the same contract specification, obviously apart from the delivery basket, as the existing long gilt product. How have they done? Well, they've done okay. They haven't sort of set the world on fire, but only 3-4 months in, we've had the open interest has peaked at nearly 29,000 across both products, which isn't bad for a brand new product. In terms of the usage of the contracts, we have had 13 out of the 16, I think that's 14 now, out of the 16 gilt-edged market makers. These are the firms, the banks, typically, that trade the underlying gilt market in the UK. They've actually been reasonably good-sized users of the contracts, and they've been quite supportive. They haven't actually tried to discredit the product. Some of them have actually got quite big positions in there, so that's very, very useful. And we've got 7 market makers supporting the contract. So if you are more of a bond futures trader, there is a new trading opportunity there for you. How have they done volume-wise? Well, again, you should look at the charts there. The volumes aren't enormous, but it's certainly heading in the right direction. This is just a little print we took from CQG of the March contract, which has rolled off now. But the point of this is just to highlight, obviously in the early days, market makers were struggling, for the contract to find its range, and it's now trading in a far tighter range. And it's just the Bloomberg equivalent. Medium gilts has been a smaller marketplace, but we did expect that. Again, there isn't really as many trading opportunities for, if you like, a TED spreader who would more naturally look at the 2s against the 10s or the 2s against sterling. Similar sort of story in terms of it is more choppy actually than the short gilt, as you probably expect. But again, the market makers were struggling here in the early days, but it's starting to trade in more reasonable ranges now. And just really to finish on the long gilt, which are the basis for launching these products. The long gilt itself is a well-established contract on life. It trades well over 100,000 lots a day. It's sort of developed over the years between different delivery baskets and coupons to be what it is today. It's got a healthy mix of users in there. It has got good volumes. So that is a good contract for you to look at immediately. I'd say the open interest is up over 300,000. And there's just an average daily volume chart. And then just to finish off, I mean, it again goes back to what Dan was saying about some of the TED spreading opportunities. Offering the short, medium, and long gilts does open a few new trading opportunities you might want to look at. You might want to look at curve trading. I've just put there the exact ratios, the duration weighting ratios as they are today, although that does change, obviously, with yields over time. TED spreading we've talked about, and then there are people trading these gilts against the German equivalents. So maybe there's an opportunity there to look at. For yourselves, what are the next steps? I mean, we've talked a lot today about different opportunities. Really, there's no downside for you just to register on a liquidity provider program. There's no obligations on yourselves for doing that, but immediately, if you do start trading our products, you'll be immediately eligible for rebates. I know there's nothing more frustrating for an individual trader to actually start trading significant volumes, then find out for whatever reason the paperwork hasn't been captured at the exchange and you're not getting your rebates. So please do register. There's no downside to do so. And on our website, at that link, there is the registration form, and there's a helpful little calculator where you can work out what rebates you'd be eligible for, dependent on volumes. So that's what I would call the next steps. Here's our contact list. So, you know, Marco opened the presentation. Marco's based in New York. There's the Chicago contacts, which we pointed out. So Mark Phelps here at the front has literally flown over from the UK, and he will be based here. Mark worked in the fixed income team for myself for a number of years, and he really is an expert on interest rate products. So please do use Mark as much as possible. Myself, Paul McGregor, I'm based in the UK. I am over quite often, and Peter Best, who's our head of product development at the back there as well. We're all around for questions. Now, unfortunately, I know we can't serve alcohol here. We've been told we're not allowed to. But I think we're going to be putting our card behind the bar over at the W. As I say, Dan will be joining us, so I'm sure you've got lots of questions you might want to ask him more on a bilateral basis, not in here. But thank you very much for listening.